Last week, all 10 of the best performing stocks on the S&P 500 were all in the energy sector. And this followed a surge in oil price due to the escalating tension in the Middle East. Oil price is currently around $78 per barrel for Brent crude. These and many more, I'll be talking about them on this episode of Market Tape. On this episode, I'll be talking about exchange rate, what you need to know about the energy sector, investing in the energy sector, and of course about the fixed income market where rates are trending up to over 20% at the moment. Welcome to another episode of Market Tape. My name is Nathan KC Nwokoro, and I'm here to bring you up to speed again with the Nigerian and global capital markets. So make sure you subscribe and activate the notification button. As always, nothing said on this show should be construed as an investment advice or solicitation to invest or buy any security. Everything I say on this show is for information purpose, and you want to make sure that before you put them to use, you are speaking with a professional who is going to give you the sort of guidance you need to make the best decisions with your investment. Investing comes with different degree of risk, and you want to take into account all of this before putting any of the insights I share on this show to use. So to get started this morning, we starting with the energy sector, where oil price is hitting $78 per barrel. And this is due to escalating tension in the Middle East. Last week, we saw Iran attack Israel directly, sending, I think, over 180 missiles to Israel. And the expectation is that Israel is going to respond. Israel is going to retaliate. And some people are going as far as saying that we are on the cusp of World War III. You know, I will not go as far as saying that this will all lead to the Third World War. No, I won't go that far. But it's certainly source of concern. You know, as investment analysts, when we make predictions, when we make forecasts about the economy, about investment, one of the things we take into account is geopolitics. And truly it matters, geopolitics matter, because you can't expect economic prosperity, you can't expect businesses to do well in an era where there's chaos, in an era where you have this geopolitical tension among countries, particularly in the Middle East, where we have most of the world's crude oil supply coming from. The stability of that region is important to world economy and what happens with the energy sector. For instance, if you have tension in the Middle East, it's going to lead to higher oil prices, which could even lead to higher inflation. We're coming out of an era where inflation has been an issue globally. So the last thing we need is for oil price to go back up to $120 per barrel, that kind of price. It's certainly going to have impact on inflation. That is going to have impact on businesses, profitability, and all of that. So you take all of this into account when you are making economic forecasts. So last week, we saw the market reacting to the new dimension of the conflict between Israel and Iran. You know, so far it's been some sort of proxy war between Israel and Iran. Iran on one hand fighting Israel through militants in Syria, in Lebanon, and of course in Palestine, where you had Hamas. Incidentally, this is 1 year, October 7, 2023, Hamas attacked Israel, killing, I think, about 1,200 people and taking about 250 Israelis hostage. And since then, we've had discussions about ceasefire to no avail. And for the first time, Iran attacked Israel directly. And I think Iran had to respond at some point because Israel has taken out one of their commanders, Ismail Haniyeh, one of the top commanders of Iran. Israel took them out recently. Israel has attacked Iranian interests in Syria and a couple of those countries. So at some point, they had to respond, and that is what has happened. And the fear now is that this conflict might escalate beyond the low-level indirect warfare we've been seeing between Israel and Iran, because you've seen Hezbollah militants in Lebanon. They've been exchanging fire with Israel, and as we know, these militants are all backed by Iran, whether it's the Hezbollah in Lebanon, the Shia militants in Syria, Hamas in Palestine. All of these guys are, and even the Houthi rebels in Yemen, they're all backed by Iran. So the fear is that this conflict will escalate. Currently, Israel is fighting on about 3-4 fronts, fighting all of these militants. And so the fear is that this conflict can escalate beyond the Iran's axis of resistance, which is basically Lebanon, Syria, Iraq, and then Iran itself, and then to some part of Yemen. So the fear is that the conflict will escalate to other parts of the Middle East. What the market showed last week indicates that the market thinks that this conflict will escalate. So I'm going to talk about what I think also. Do I believe that the conflict is going to escalate to the point where we're going to see oil price go back up to 100 or above $100 per barrel? If you look at all the top energy stocks last week, the 10 best performing stocks on the S&P 500 for last week, all 10 of them were in the energy sector. All 10. No stock made it to that list from other sectors apart from the energy sectors. So there is some sort of indication that the market believes that this conflict will escalate, and that the best place to be in for last week, as far as last week was concerned, is to be in the energy sector. Of course, the risk is always there. How would Israel respond to Iran? How would they respond? Obviously they have a lot of options. What most people predict is that Israel is going to respond by attacking their Iranian military establishments, rather than, as opposed to attacking their oil installation or their nuclear sites. Because the other two, whether Israel responds by attacking their nuclear sites or oil installation, will be asking for all-out war. I don't think Israel would go that far, because Iran economically has been struggling lately. So Israel hitting their oil installation, oil facilities would mean saying, hey, we are coming for your soul. And then Iran will likely go all out, probably start to use nuclear weapons against Israel. So I think so far, both Israel and Iran have been measured in how they approach direct confrontation with one another. So I think Israel would still try to keep to that. But if this whole war has told us one thing about Israel, is that there is no measuring what the extent they will go to defend themselves. So no one anticipated that Israel at this point will be fighting the Houthis in Yemen, Hezbollah in Lebanon, and the scale of attack on Lebanon is I don't think anyone anticipated that. Currently, they've made attempts to send in ground troops into Lebanon to try to root out Hezbollah permanently. I think this is what Israel is trying to do. But for direct confrontation with Iran, they have been careful, both Israel and Iran. They've both been careful in hitting one another, where it could trigger wider conflict. The attack by Iran, there was no civilian casualty apart from a Palestinian individual that was killed in that attack, and I think it was fallout from the missile sent by Iran that struck the guy. I think the intention was not to have civilian casualties. So Iran has been kind of diplomatic in how they attack Israel, and everyone expects Israel to respond with the same level of diplomacy. But let's wait and see how Israel responds. If Israel goes ahead to hit either Iranian oil facilities or their nuclear sites, because when it comes to military might, Iran is nowhere near Israel. So the only thing they have to respond in the same might as Israel would to respond in the same might that Israel will hit them is their nuclear program, and Israel hitting that would be like coming for the soul of Iran. So I expect that Israel would avoid hitting their nuclear sites or hitting their oil facilities, because hitting any of these two will certainly lead to a wider conflict in the Middle East, because it's going to draw in other actors. You might see a situation where these militants will start to attack oil facilities in Saudi Arabia, Qatar, United Arab Emirates. So that is the fear, and I think the market is sensing that could be a possibility. Iran contributes about 3.3 million barrels of oil per day to the global oil supply, which can easily be replaced. So it's not just about Iran getting into the conflict, it's about the conflict spreading and reaching the likes of Saudi Arabia, Qatar, UAE, and even Jordan, and even Iraq. Iraq currently produces about 4.4 million barrels per day, and Saudi Arabia is one of the top 3 oil producers in the world. So any conflict that affects Iran, Saudi Arabia, UAE, Iraq, Qatar, then it will certainly have impact on oil prices. And this is why we saw these energy stocks saw their prices go up dramatically over the weekend. So if you look at the chart, you had some of them going as high as 16.76%. Vistra Corporation went as high as 16.76%. Diamondback Energy added 12.88% for the week. So on the average, most of these stocks were up close to 10% for the week, 9-10% on the average for the week. And so this is what we saw last week. And the question is, should you be buying into the energy sector? Should you be investing in this sector? So the thing about investing, I would say that if investing were a building, then diversification will be the solid foundation on which everything stands. So diversification always is what I preach. Diversification is very important when it comes to investing. I wouldn't advise anyone to just go pile into the energy sector because of this. I mean, it's something. It's a short-term trend that would likely go away, depending on how this whole conflict shakes out in future. But by and large, what I always will preach is to have a diversified position. So if you didn't have anything in the energy sector, you may consider adding some of it, depending on your long-term investment strategy. But you need to understand how the energy sector works. The energy sector, the stocks in this sector mostly depend on crude oil price. And as we know, crude oil price is very volatile because it depends on geopolitics that you can hardly predict what countries will do with one another, particularly the oil producing countries, the OPEC countries. So it's difficult to predict. So energy sector is very volatile, and you want to make sure that you are capturing that in how you invest in the energy sector. The role that energy stocks play in a portfolio, for me, basically are two. One, capital appreciation and income generation. Most of the stocks in the energy sector are some of the highest dividend-paying stocks we have in the market. Some of them, I know the dividend yield, well, you find dividend yield in the energy sector up to 8%. And at some points, you could see dividend yield at almost 12% for some of the energy stocks. So if you are an investor who is looking for income generation, this may be one direction you want to look at the energy sector to see if you find names that match your strategy. But in terms of capital appreciation, the energy sector will not give you the sort of capital appreciation you see with technology sector and some of these other sectors like communication, even healthcare, on real estate. You won't see that sort of capital appreciation that you get from the tech stocks. You can't get that in the energy sector. The capital appreciation component is something that happens slowly over time. So you want to, if capital appreciation is your thing, you want to be very discretionary with the names that you pick in the energy sector. But one stock that has been doing well lately is Vistra Corporation. Last week they did 16.76%. Year to date, they've done over 260% year to date. And in the last 1 month, the stock has returned 88%. So, and this is coming on the back of the fact that Vistra Corporation is one of the largest power producers in the United States. And the company is seen as one of the companies that will best benefit from artificial intelligence. As we know, artificial intelligence is a power-hungry innovation. Most of these data centers need a lot of power to operate. So Vistra Corporation is one of the names that have been identified to benefit immensely from increased demand for power, especially as driven by artificial intelligence. So a couple of other names too, like Constellation Energy is also projected to benefit more from artificial intelligence. And then you add the fact about higher energy prices due to the conflict in the Middle East, and it becomes another headwind for these stocks, these names to continue to thrive. So for people who are interested in diversifying their portfolio into the energy sector, you need to take into account these two factors, the capital appreciation component and the volatility that comes with it, and then of course the income generation, in the sense that if every other thing fails, if you are not able to get capital appreciation, some of these names pay high dividends that you can use to moderate the impact of the volatility in that sector. So moving on to Nigeria, one other name that I want to talk about is Seplat Petroleum. Last week, Seplat was the second best performing stock on the NGX. Seplat added 21%, and I think it's also based on the recent happenings in the Middle East, higher energy prices. Seplat is one of the biggest oil and gas exploration companies in the company. The company has been doing well lately. Revenue growth has been fantastic. Dividend yield, the company has been paying dividend very regularly. The dividend yield is currently at 3.84%, and they also have excellent liquidity ratios. So it's a well-run company. My only issue with Seplat is their profitability ratios. It's not as fantastic as other companies that we track on the NGX. But by and large, it's an excellent company, and they're positioned to benefit from higher energy prices. So if you see, if this trend continues, if the increase in oil prices continue towards the $100 per barrel range, this is one name to look out for, Seplat Petroleum. And then to exchange rate. Exchange rate has been on the mind of everyone in the last 1 year or so, or in fact in the last in the last since 2020, in the last 4 years, exchange rate has been something else. And for anyone who has had any foreign denominated obligation, I'm sure we have worries about exchange rate. So we've seen stability with exchange rate very recently, but it does appear as if slowly but steadily we keep pushing towards 200 Naira per dollar at the exchange rate market. If you look at the forward rate seems to indicate that we are headed towards 200 200 Naira per dollar as exchange rate in the next 1 year. So the forward market is where people who want to, buy dollar ahead in terms of risk management. For instance, if you are an importer and you're not sure what dollar will be next year, and you have need to import goods into the market next year, you can go to your bank this year and enter into a forward contract where the bank sells dollar to you by next year. So today you agree on a rate with the bank, and by next year, the bank will deliver dollar to you at the rate agreed today. So in that market, the exchange rate, the 1 year forward rate is actually 2,095, which kind of leads to the notion that the market actually believes that we'll continue to see the Naira lose value going into 2025. And I think this is one very bitter pill for many of us in terms of how we digest this information. Most Nigerians honestly want to see exchange rate improve, want to see better rates. So the sentiment around the country is that people will actually fight the notion that the Naira will lose value. But we keep seeing this happening, and we've tried to clutch to straws of hope here and there. And particularly, one thing in my opinion, that a lot of people overweight is the benefit from the Dangote refinery. Because on one hand, we are going to see savings from refining our products locally. But on the other hand, don't forget, we are selling crude to him in Naira, which means that the supply that comes from that portion of crude we are selling to him in Naira will no longer get that supply in the FX market, which kind of offsets some of the gains that you get from refining locally. So we need just more than having the Dangote refinery to see the Naira strengthen. We need more than the refinery. And I keep speaking about the level of crude production. We can't be, I think currently we are doing around 1.3 million barrels per day. For me, that level of production is far below what we should be aiming for as a country. Crude oil production needs to ramp up to 1.8 million barrels per day, or even 2 million barrels per day. We need to see crude production go up to that level for us to see an improvement in the value of Naira. Otherwise, slowly but surely, we'll likely get to this 2,000 Naira per dollar valuation for the Naira. And then you don't even know what the true demand for dollar is, because there's a lot of suppressed demand by regulators, particularly the CBN. There are items that you cannot get dollar for officially. But some of these items, you need them in any case. There are a lot of businesses use softwares that come from abroad. And these softwares, I doubt if you can go to your bank and request for dollar to pay for this software. Emails, antivirus, accounting applications, some of these things, businesses need them, and they have to go source the dollar in the open market. So we don't even know what the true demand for dollar is in the country. And until we do know what the true demand for dollar is, you can't expect to have stability. So you saw the exchange rate really move up last week because the CBN did not intervene in the market last week. In the official market, exchange rate went up to about 1,631. in the NAFEM market and then 1,660 in the NAFEX market, because the central bank did not intervene in that market. So the central bank we need to always keep intervening in the market to keep exchange rate at bay. And to their credit, particularly from all the borrowings and the foreign portfolio investment inflows that have been seen come into the market from the OMO auctions of the central bank, we've seen our foreign reserve go up to almost over $38 billion, which gives the central bank more ammunition to try to stabilize the exchange rate. But obviously, we need more than these borrowings. We need more than the Dangote refinery. We need the crude production to go up. We need to diversify our foreign exchange earnings base, agricultural commodities, manufacturing, which is stunted. The growth in our manufacturing sector is kind of stunted currently. We need to see that improve to see any meaningful appreciation of the Naira. Okay, so let me circle back to the US market. The S&P 500 closed in the negative territory, despite the fact that we saw this energy sector, stocks in the energy sector perform very well last week. But the S&P 500 overall closed negative at 0.17%, and that begs the question whether we will see the October effect play out. The idea around the October effect came from high-profile crashes that we saw in 1907, 1929, and 1987, leading some analysts to believe that October is not an excellent month for stocks. But if you look at more recent history, October has not been a bad month for the stock market. But you can't also say it's an excellent month for the market either. So it's that month where the performance of the market is just there, nothing spectacular to write home about. But for this October, what would one expect to happen in the market? For me, the US economy continues to show strength. Last week, we saw the job report came at 254,000 jobs added. The most recent job report indicated that 254,000 jobs were added. Inflation has been trending downward, and we expect another rate cut when the Federal Reserve meets next year. And all of this is a tailwind for the stock market. It's expected that earnings growth will continue to strengthen in this fourth quarter. Earnings growth is expected to come at about 10%, and then 5.8% for revenue growth across the S&P 500. So I don't expect it to be a negative month for the market, particularly because of the expectations that we'll see stronger earnings when these companies start to release their Q3 reports starting from this week. Next week, we're going to see more. This week, I think JP Morgan is the only stock that we track that will be releasing its earnings. For next week, we're going to see reports from ASML, Taiwan Semiconductors, and a couple of companies that we track. And I'll be here to run you through those reports as they drop. But we expect the results that comes out from these companies to either meet or beat market expectations. So I don't see much downside to the month of October. But as I always say, when you see a downside, it becomes an opportunity to see names that you can add. Most stocks currently are trading at all-time highs. So buying, even investing in companies that you like is actually difficult currently because of the current prices. So a market downturn will provide an opportunity for us to add some of those names. Personally, there are a couple of stocks that I'm tracking. I'm looking at them, and if the prices come down, then I'll likely make my move and get more of them. And to round up the fixed income market, we saw tight system liquidity last week, which pushed average yields up for the Treasury bill market and the bond market. There will be a Treasury bill auction this week. The last auction for 1 year closed at 20%. I expect this week to close over 20%, but personally, I don't see 21% happening. What I would expect is something around 20.4 for the 1 year Treasury bill at the auction this week. But we'll keep our ears to the ground to see what happens in the market. And then for the bond market, we saw yields still trend up last week. The 10 years bonds closed well over 20% for last week. Some of them touched 21% last week. And the same trend, I expect the same trend to continue this week as we navigate the current liquidity levels in the market. If you've made it to this point in the show, I appreciate your listening. Thanks, and make sure you subscribe.